Hello, everyone. My name is Emily Ritchie. I'm the director at the Northwest Cider Association. I'm so glad to have you all here in the live webinar, as well as the recorded version that will go on our YouTube channel. I'm excited to be here and continue our webinar series and provide really important information right now during the COVID pandemic, but also just important information to run strong businesses here in the cider industry. And today we've got a really wonderful speaker lined up for you to talk about cash flow. So I will introduce you to Maria. Maria is the speaker from Perkins Perkins Accounting. They are the area's largest locally owned accounting firm, and she is the author of the Small Brewery Finance, Accounting Principles and Planning for the Craft Brewer. She has over a decade as in the accounting business, and as well, she used to be in the radio and music industry, which is pretty cool, from South Carolina. So I'm delighted to have her here to speak with you, and I'll turn it over to her and she can share her screen with you all.
Thank you. Thanks for having me. I wanted to touch on some principles today about your financial strategy within this COVID era, because so much is up in the air these days, and having your ducks in a row financially is one piece that you can do to sort of control the chaos. So let me share my presentation, and I'm going to be bouncing back and forth between PowerPoint and Excel because I do want to show you how to build a cash flow forecasting tool. I've got some screenshots in PowerPoint, but I think it might be a little easier to look at it in Excel as well. It's just a bit more nimble of a tool. So let's see, get my screen situated. So today we're in a place where it's definitely uncharted territory for all of us. There still is a strong demand for beverage alcohol. No matter what beverage you're producing, that is still strong. It's just that people are getting it in different ways. So even though there's a demand, it is a challenging time for all suppliers. And then you consider the market forces that are at play. Our on-premise sales are significantly reduced, if not nil altogether. We've also got rapid changes in the regulatory environment. Most states are relaxing their restrictions on direct-to-consumer sales, and that is an ever-evolving arena where you really have to stay on top of the regulations and how they're changing on a very frequent basis. And it's also interesting to think about the regulatory changes that we're experiencing now due to COVID. How might that kick open the door for some longer term changes to the industry as a whole? It perhaps might lead us to a place where there's not as much power that's held at the distributor level. So I think that's one area where we could see some significant silver linings out of this. But right now, on the day-to-day, on-the-ground impacts, it adds more confusion to the mix. Your consumers, they have less disposable income, and so people who may have previously bought at a certain price point on the shelf, they might be bringing that down a little bit, or they might be shifting their buying habits. I work a lot in all sectors of beverage alcohol, and in beer, we're seeing an uptick in mix packs. So, that's something that one example of how buying behaviors are changing in this COVID era as well. And we've also got this undetermined timeline for social distancing. So it's a little unclear how long we're going to be in this weird Twilight Zone experience. So how can you bring some certainty into the financial realm amid lots of chaos? So some core tenets here is to manage your cash flow. We're going to talk about this in depth. And then also positioning your company to be nimble and make changes on a dime, and thinking about your chess moves for the next strategic choice for your business. So the chess moves idea is having a long-term vision, planned out, and understanding the different paths that you might take when it's time to shift strategy. So paramount is cash. Cash is the oxygen to any business. It is your lifeblood, and cash flow is what's going to separate companies who are able to sustain this period versus those who struggle and maybe need to fold. So I am hoping to share with you strategies on building a cash flow forecast that can get really detailed and allow you to really fine tune and thread the needle when you need to thread it with your cash. So a cash flow statement, you might be familiar with a cash flow statement. That is one of the three basic financial statements that make up a complete set of financial reports: the balance sheet, the income statement, statement of cash flows. Those are three that kind of go together, and you don't have a complete financial picture without it. The cash flow statement ties together the balance sheet and the income statement. So a question that I often get from clients is, my income statement says that I made money, but I don't see it in my bank account. And the cash flow statement helps to explain what you see on your income statement versus the available cash in your balance sheet. It shows you the sources and uses of funds. A cash flow statement is always historical looking. The difference between a statement and a forecast is a forecast looks forward into the future. So it's the same idea of tying together the cash balance in the bank versus the income on the income statement, but you're just doing it prospectively into the future. So critically important for seeing where your low points of cash are going to hit, and it helps you to get some strategic planning in place so that you don't fall into this negative cash position. So the way I like to build a cash flow forecast is in Excel. A lot of your accounting packages like QuickBooks, or if you're using orchestrated beer for your cider or Xero, there is a forecasting tool in most accounting packages, but I wouldn't recommend using it because it's really difficult to handle inside a software. The nice thing about Excel is that it's much more flexible for your needs. Also, if you think about building a forecast in your accounting package, like let's say you use QuickBooks, you would have to enter in kind of like fake bills for what you expect to receive in the future. But then when you actually receive your real bills in real life, you're going to have to make sure you go back and take out the placeholders. So it can get confusing, it can cause a lot of chaos, and I find that doing this in Excel is just the most user-friendly. So the forecast that I like to build is 13 weeks into the future, and it's kind of multi-tabs, and I'll show you the different tabs and how they work together. But I love this format because if you take it week by week for 13 weeks, that's a quarter of a year, it can help you see with great detail far enough into the future that you can prevent yourself from going into these periods of low cash or negative cash. And if you do see them, there's enough of a runway to try to mitigate the risks of going into that negative cash position before they're right on top of you. So I'm going to show you the summary sheet, and then I'm going to flip over to my Excel document so we can work through it together. But the summary sheet is kind of the top sheet where everything comes together. And you can see that I've got my columns broken out into distinct weeks. And then along the rows, every row ties to a separate sheet in the workbook. And I'll show you that in a second. But basically, if you were to look at how the numbers are derived up here in this section where you see dollar amounts, it's just deriving straight from the detailed sheets that back up the summary sheet. So we have receipts of AR, payments of AP, operating expenses. And the difference between payment of AP and operating expense is that AP are like bills that you're receiving into your business. And then versus operating expenses, these are expenses that you don't necessarily receive a bill for. For example, payroll or perhaps rent. So you definitely need to take those into account, but you're not necessarily going to receive a bill. Investing and financing are sources and uses of funds that are either you buying equipment or pulling on a loan from a bank or paying back a loan from a bank, taking in money from investors or paying a distribution from investors. So it's ways in which you're using or getting money that aren't related to the core operations of the company. So the sum of all those lines will result in your change in cash for a particular week. And then, so in this example, we've got a change in cash. We're going to use, let's call it $41,000. And then our beginning cash balance is what was in the bank at the beginning of the week. And then you simply add these two together, and that gives you your ending cash balance. That's simple enough. Personally, I like to add in a margin of safety line because you want to factor in the amount of money that you want on hand that helps you sleep well at night. And for most businesses, that's going to be about 3 months of operating expenses. That's a good margin of safety to have on hand. So you want to factor in for that and then subtract that from the ending cash to show you what your available cash is. So theoretically, you could run your available cash down to 0 or almost 0 and still be fine because you've got that margin of safety there. Whether or not you use these two lines with margin of safety and available cash, that's personal preference. But I'm just showing you, my personal preference as using this as a management tool. So let me pop over. I'm going to go into Excel. Let's see. Okay, so this is the same summary sheet that we were just looking at on the other page. And to give you a sense of how it's built, like if I click in any of these, you can tell that it's just coming straight from a different tab in the workbook. So let's start to dive into those different tabs. So the first one, they just go straight in order of how you see them presented down your rows. Let's go into AR. And this forecast is built assuming that somebody uses QuickBooks. And I built it using QuickBooks just because it's probably the most prevalent software that you see out there for small businesses, regardless of industry. So the way you build your AR detail tab is first by taking your AR aging report out of QuickBooks, dump that into Excel, and then you can simply copy and paste into here. And some of the columns have been removed, but at the end of the day, you're left with the due date of the invoice number, the customer, the date of the invoice, and then the due date of the invoice. Then a calculation of if it's past due or not, and how much of the invoice balance is past due, or is still open rather. And then using your columns over here, this is set up in the same way as your summary tabs, and you just line up when you expect to receive the payment for these invoices. So anything that is already overdue should have come in already. However, you haven't received it yet, so that's going to be a manual process where you as the person who is keeping up with this spreadsheet needs to put it in the right place based on what you know about the customer and any kind of conversations you've had when you expect to receive that payment. So all of your open invoices are going to be, here in this top section, and then they will show up as arriving in a particular week based on what you know about that customer. Down here in the sales orders section, so let me back up a second. The problem with stopping just with your open AR is that it does not account for everything that you're going to receive for the rest of the 13 weeks. Whatever you have in AR is probably going to come in, no more than 8 weeks in the future. So how do you account for those other things, that invoices that have yet to be made throughout the coming 13 weeks? Well, there's 2 additional sections. After your invoices, you're going to put in sales orders. So these are sales orders that have already been placed with you, but which you have not yet shipped, and therefore they are not invoices. So you list your sales orders. You've got the date of the sales order, and then you've got the projected due date. So here I'm saying that I received this sales order on December 20th. I'm not going to ship it until, let's say, January 6th. So I expect my projected due date for this to be February 5th. And then I put in the amount based on the sales order. Then I'm going to come over, and when I get down into my sales orders, I can use formulas to dictate which week it lands in. So, you know, you can see that this is derived by a formula. And then beyond any sales orders that are already in the door, you need to account for things that sales orders which you have not yet received, but which you expect to receive before the end of the 13 weeks. So down here, I've listed out what I expect to come in. And so I'm saying that, you know, for each distributor, I expect that I'm going to ship to them twice a month. So distributor A's got one on the 15th, distributor B's got one on the 15th, and so on. And then my projected amount, I'm just using kind of a round dollar figure, but based on the historical sales to that distributor and also what I know about this current period, that's my best guess for how that's going to be. So, or what dollar amount that'll end up in. So the same theory applies. You take those forecasted sales orders and then kind of plot them down into the week that you think they'll arrive. So the end result after you've built this tab is you're accounting for all the money that you expect to receive in over the 13 weeks. Each column for each week has a total, and then this is going to feed back over to your summary tab over here. So your AR lines up in the correct week, and it will correspond directly to this detail tab. So that's how you go from, you know, the detail of QuickBooks into building your forecast for AR. The next row down has to do with AP. So to build your AP tab, you're going to follow the same structure of workflow for the most part. If you're using QuickBooks, you'll take your AP aging report, dump it into Excel, copy and paste it into this tab. And here you can see I've got the date of my AP invoice, I've got the identifying number of it, the vendor, the date at which it's due, how past due it is, if any, and then the open dollar amount on that invoice. So same thing, when you're looking at stuff that is past due, you should have already paid it, but you haven't. So putting those dollar amounts into the right week over on the right is really, you need to do that manually based on what you know about the relationship with the vendor and any particulars about when you expect to pay it. So that's really something that is a pretty manual process. Like there's a reason that these are past due. And so that is a bit of a manual process for you to assign the correct date that they'll be paid. Once you get down into the AP that's current or not yet due, then you can use formulas based on the due date. So, you know, you can see up here in my formula bar, this is derived from the due date of a particular invoice. So you can kind of watch it cascade and waterfall through there as we get further out in time.
I have a question.
Okay.
For those with tasting rooms or online sales, would you just add rows for those sales?
For a tasting room, yeah, you probably want to build a separate spreadsheet for that, and kind of follow the same format. That's going to be kind of a simpler exercise because most tasting rooms have some kind of you know, basic dollar amount that you can count on. Like you can say, oh, I expect I do $2,000 on the weekdays and $5,000 on the weekend or something like that. But yeah, you would just build that out in a separate tab and then add that in. When you get over to the summary, you would add, like, you know, add a row right here underneath your wholesale AR for what you expect to do in your tasting room. So on AP, what we've done with this exercise is basically we've accounted for every bill that we already have that's sitting in our system thus far. But we know, I mean, you can look and see that the furthest out we go is like 1 month into the future. So clearly there are going to be more bills that happen before the end of the 13-week period. And that's where the operating expense tab comes in. So if you hop over to operating expenses, I have this broken up into two sections. The top section is called expenses generally not invoiced, and this is things like guaranteed payments and payroll, rent, taxes, etc. And then down, oh, and then I have other, and this other line is just meant to be like, you know, you're walking around money. Like this is kind of, oh, I got to run to the hardware store or whatever the case may be, just kind of general expenditures that aren't necessarily planned for, but happen to come up in day to day. And then there's another section called expenses generally invoiced. So these are things that you do expect to get a bill for. It will work its way through the AP of your accounting software, the AP system of your accounting software, but you haven't gotten the bill yet because you're not that far into the future. So I broke it down kind of into general buckets: direct materials, insurance, maintenance, etc. You can read them here. And then you see that there are a few weeks where I've blocked it out because this is already included on our AP in the other tab over here. So I want to make sure not to double count it. And this is the rest of these weeks are my holding place for what I expect to get from in future weeks for these particular categories. So, you know, with direct materials, I might assume that I'm ordering raw materials or packaging materials once every 2 weeks. It generally is about this much. And I'll show you some detail on how I arrive at these numbers in a second. Insurance, you know, I'm going to pay that once a month. Maintenance, I expect I'm going to have, you know, roughly $875 in maintenance fees each month. Professional fees, again, like, you know, there's kind of a monthly cadence to these things. And you can make the cadence whatever you want. Up here in payroll, we have a bi-weekly cadence. I'm estimating that I'll spend roughly 42 grand in payroll every 2 weeks. My rent is on a monthly cadence, etc. Taxes is, you know, let's assume this is excise tax. It's hitting at the end of a quarter. So I'm going to make a big payment at, you know, before the 15th of the month. So let's look at how I'm arriving at this. You can see that in the formula, I arrive at my idea of what I'll spend based on data from a pivot table. So let me show you how I get this. Okay, so I've taken a historical income statement and dumped it out by month for the trailing 24 months, and then I turn that into a pivot table. And I have added some, so I've got account names here, and then I added just general descriptors in column A. So, you know, like for example, in my production costs, I've got raw materials, supplies and materials, storage fees, process costs, but I want to think about all of those in one bucket called direct materials. So I just categorize and give them, you know, kind of a category name in column A. And then I take this spreadsheet, turn it into a pivot table. I've got the name of my big categories in column A here. And then I've got the total of that category in the, you know, in the columns that follow each month. So you can think of what I've done here. I've basically taken this historical income statement and shrunk down the number of rows into something that's really consolidated that helps me think about my expenses like by category. It's not necessarily financially correct in terms of how these things are termed, but it helps me conceptualize how I'm spending my money, what I'm gonna, you know, how I want to think about categorizing them on my cash flow statement. So we do this, we have, you know, month by month data, and then you can come across and look at your total. And then the nice thing about using a trailing 24 is that it is a long enough time frame to take out anomalies and kind of give you a more true to form idea of what those expenses will be. So once I've got my total that covers the trailing 24, I can go back and think about what an average of that cost might be. So when you plug these into your operating expense detail, you can see that here in direct materials, if I look at my formula, it's coming from, I'm basically pulling this from that pivot table that we just looked at, and I'm taking the total, dividing it by 48, because remember, I'm assuming that I'm going to be paying this every 2 weeks. So I take 24 months, multiply it by 2, that's 48. And then I'm assuming that there will be a 3% increase in the general cost of my direct materials because I'm 1 year into the future. So you can think of that as inflation or just kind of general increase in costs. But that's how I'm accounting for it, is by multiplying it by this 1.03. At any rate, sorry, I kind of got way in the weeds there, but that's how I arrive at what I'm going to plug into expenses that I expect to hit in the future, but which I haven't yet gotten a bill for. So it follows the same methodology where all the expenses are dropping down to the bottom of the column. Oh, and you can see I made some notes here. So assume annual cost increase. This was, like I'm saying, I think that my costs in general are going to increase 3% this year versus if I bought the same thing last year. And then I've got some notes here about how I'm deriving the cost. So use average monthly expense from the income statement, assume purchases every 2 weeks, increase expenses 3%. So you can add notes if that helps, kind of keep your mind straight about how you're arriving at these numbers. At the end of getting this tab built, it's going to go back and flow into your summary tab as well. So, everything is just like building from the detail tabs here. So the last tab that we need to look into is your investing and financing detail. And again, the types of inflows or outflows that you have here relate to, if you're going to spend money to buy tanks or any other capital project or improvement, that's an investing type of outflow. On your financing, if you are, pulling on a line of credit, that would be an inflow from financing. If you're paying it back, that would be an outflow due to financing. And then on the investor or owner side of things, if people are contributing money to you, it's an inflow from financing. Likewise, if you're giving a distribution to your owners, it's an outflow. So in this situation, we're assuming that we make monthly payments to a bank loan of $82.67, and this represents just the portion of the payment related to the loan principal, not the interest, and interest would be separate. So the positive amounts you see are outflows to pay back that loan, and then I am planning on pulling $25,000 from the line of credit. So that's going to be a negative amount. It's a disbursement, so it's cash to me. Up here, you can see these 30,000s. This is my down payment on tanks, and this is my second payment when I expect to receive them in. So same structure, it all falls over to your summary tab, and you get your change in cash right here. Your beginning cash balance is going to come from your bank account. So we would populate this beginning cash cell with what our bank balance is at the beginning of this week. So at the very beginning of, so 12/29/19, that's what my bank balance was. And then you can see the formula here is we're just adding C12 and C14, so beginning cash and then the change in cash. And my amount to sleep well at night is that $500,000, so I'm going to plug that in here. And I see that, I'm actually, I don't have as much cash on hand as I need to pay what I want. So I'm either going to have to get comfortable with having a lower margin of safety, or I'm going to need to rearrange some of the payments to my AP, or I'm going to have to bug to get my AR in sooner. But having this visibility, then you can go back over to your AR detail and your AP detail and really fine tune this. So the receipt of the AR is not as much in your control as is the payment of your AP, obviously, because you're the one writing the check. So when you get over to your AP, you really can kind of fine tune when you're going to pay which bill and how much of each bill. And that's helpful to thread the needle when cash is getting really tight. So what I like about having this 13-week model is that it's detailed enough that you can really see the effects to your cash flow just by a minute change from one week to another. And it helps you manage on a very detailed level. Now, once we get out of COVID era, I don't necessarily think you need to do a cash flow that is, that detail oriented. But for the situation that we're in now, it might be really helpful to have that. So it can help you stay nimble. So I want to go back to the PowerPoint real quick. All right, so summary sheet, so we went through all this on Excel. Okay, so other management techniques that can help you manage your cash flow is to minimize your fixed costs. Think about all of your regularly recurring expenses and then identify whether or not they're a fixed or a variable cost. A fixed cost is a cost that's constant no matter how much you're producing and selling, like rent or salaried employees. You're always going to pay the same amount regardless of the level of production. On the other hand, variable costs change relative to the level of production. So, if you have hourly labor, your direct materials, you're going to spend more on those things the more that you produce. So variable costs are easier to manage in times of tight cash flow because you can dial them up or dial them down depending on your production. You're only going to be paying for them if you're making things and selling things. So in this period that we're in now, I would strongly recommend considering options for moving fixed cost to a variable cost. So you might find that there are certain services that you have in-house that perhaps you can outsource and put it on an hourly basis so that you can dial it up, dial it down. It's tricky. I mean, you don't want to get rid of good employees just for the sake of making something a variable cost. But I think it is an important consideration for all business owners to consider is, what's the cost benefit analysis if I made this whatever function an environment where I'm outsourcing it and I can make it a variable expense. Because when you have that fixed overhead, that's just increasing the monthly amount that you have to cover before you can be profitable. So think about what you can transition to a variable cost type of expense. And then another important thing to have your eye on is the strength of your balance sheet. It's really important to not only just look at the income statement. I think that a lot of companies get kind of wrapped around the axle about the performance of income and neglect to keep a handle on what's happening on the balance sheet. But the balance sheet is really where you're going to see the health of an organization. It's like sticking a thermometer in your company and seeing how it's doing. So some of the key ratios that will tell you about your company health are the current ratio, the acid test ratio, and the days sales inventory. And I put in bold the ones that I think are most important of these three, but let's talk about all of them. So the current ratio is a comparison of your current assets and current liabilities. And ideally you want that to be 2 to 1. You definitely want more assets than you have liabilities. So current assets are going to include cash, accounts receivable, inventory, and then any other short-term receivable that you expect to receive in, or an asset that you expect to turn into cash within a year. Likewise, current liabilities, that's going to be accounts payable, credit cards, any kind of short-term liabilities such as payroll liabilities. So you want to keep that relationship in check. A way to make that a little more stringent of a calculation is to measure the acid test ratio instead of the current ratio. So the difference between acid test and current ratio is that the acid test takes out inventory from your numerator. And that's important because the idea is you can't pay your bills with inventory. So what do you have that's either cash or very near cash? And accounts receivable is in that bucket. And with those assets, how well positioned are you to pay what's coming due in the near term? So asset test ratio really kind of tightens the screws a little bit, and it's a more strict calculation of financial health. But I think it's probably I think it's way more important than the current asset, because it's true, a lot of people end up with a lot of inventory in their books, but you're not going to be able to pay your bills with that inventory. So you're looking for about a 1.5 to 1 ratio on the asset test. And then day sales inventory is looking at your average inventory and then how many days it takes to turn that inventory over. Like if I have, packaging material, how long until I turn that one purchase of packaging material into a sale? And you want that number to be high. You want the day sales inventory to be low. You want the turnover to be high. So the idea is to keep your inventory as lean as possible without running into not having enough inventory to build the production that needs to be sold. So a lot of companies might look at their production plan, and if you look at what you need to produce over the next 8 weeks, that might be the amount of inventory that you want to have on hand at any given time. So watching that day sales inventory, that is a really good metric that helps you see if your inventory is right sized, or if you need to, if you're holding too much inventory and you need to go on an inventory diet. So in this situation with COVID, hopefully you're starting to see inventory numbers kind of get a little thinner and winnow down. You want to keep inventory in check and find that sweet spot of enough on hand to make the orders as they're coming in, but not so much that you have tied up a bunch of available cash with inventory that's just sitting on your floor. Another thing to think about is being nimble. So being nimble means that you're able to make decisions about your business strategy very quickly and change course quickly. The winds affecting our industry right now are really turbulent. There are so many ways that we're being challenged as an industry. So, the tighter your ship is, the easier you're going to be able to change with those winds. It really requires you to think short term, but also understand the long range sensibilities of those short term decisions that you make. So some ways that you can be prepared and be nimble is by being in tune with your financials. That's why I recommend reviewing your financial position and forecast, even on a daily basis. I really don't think it's overkill. I mean, if you take the truism of the more volatile your operating environment, the more important it is to watch your finances with a higher frequency. So you really have to have your finger on the pulse of what's going on financially with your company. Then also model out different scenarios. A lot of businesses are trying to decide how they're going to move forward. You might be asking yourself if this means it's the end of tasting rooms and you need to be prepared to just sell direct to consumer. What does that mean? So as you're making these decisions, I really encourage you to model it out with a financial forecast. A lot of people think, that there's so much about the future that is unknown, and I'm of the belief that's not the case. If you just keep asking why behind your questions and keep considering what is the cause of a financial outcome, if you go deep enough, there's very little that you can't forecast. You may need to form a couple different scenarios, and then you can triangulate around what the true result might be. But once you put things down on paper and draw out your scenario with dollars and cents, it will really help inform your decision making so that you can have some idea of what things might look like in reality. So as you're thinking about, our shifting landscape, consider 2 or 3 Plan B scenarios and create a financial model for each of those, and then update that frequently. It'll help you be prepared to make a move and understand what the implications of that are. Don't forget to think about like startup expenses. You might not be a startup, you may be a company that's been around already for a decade, but today, based on our situation, you're being forced to change your business model. And if you're being forced to change your business model, does that mean that you need to think about, like, setting aside another 500 grand to pivot into that? For example, if you want to go into self-distribution, what are the startup costs associated with getting a fleet, with getting enough salespeople and delivery people to manage it effectively? So there's a lot that is more than just kind of the incremental cost of each month. So make sure you look at the structural changes that need to be made to your company. A couple other best practices is stay on top of your AR. If you have customers who are on terms, then there's no reason why you can't update those. Like if someone is at net 30, can you move them to net 20? There is no written rule that says you can't change your terms for your AR invoices. And if ever there was a time to think about shifting it up and making a change, it's now for sure. And then also drawing down inventory. I touched on this a second ago. So create a target level of inventory based on what you think those future sales will be. Make sure you've got enough on hand to cover those future sales, but not much over that. Try to find that sweet spot. And if you are long on inventory, there might be secondary markets where you can offload it, or likewise where you could pick some up if you need to. So remember that there are a couple avenues that you can play with there. And then attach margin to every product that you sell. I think that the beverage alcohol space is one in which it's so many people who are in this industry are extremely passionate about their project, which is fantastic. And it is a fun place to explore and experiment, but just keep it in check and make sure that the products that you're bringing to market these days have a lot of margin tied, or at least some margin tied to it. Sometimes we get in a position where, you think the flagships are going to keep you afloat, and then you start playing with experimental stuff because it's fun. Just make sure to keep it in check, because now more than ever you need to make sure that there is margin associated with each of your products. And then along the lines with that is, do you have the systems to give you the correct data about your margins per project or per product? I really encourage companies to look at their results on a SKU by SKU level, and not just a blanket P&L. If you're just looking at your performance of draft and package sold and then the margin on each of those, I would argue it's not enough, and that you really do need to get more detailed so that you can see where you're winning and where you're not winning. This is my book, Small Brewery Finance, published by the BA in 2019. And I'm really passionate about helping people in the industry. And if you have any questions or anything, give me a shout. This is my contact information. And let's see, do we have any questions?
Yes, one question came in, said from Aiden, he said, this spreadsheet is on point. Can we get a copy to adapt to our purposes?
You can get a copy, but it's going to be protected. I'm not going to send an unprotected version, but I'll send you the protected version so that you can see how everything is related and how it's built. But it will be protected, so it's not carte blanche.
Totally fair. Other questions, folks, here? And I have been taking notes, so I will also send these out to our members after the recording. Madison says, great presentation. Thank you.
You're welcome. Thanks for having me.
Yeah, we're delighted to have you. I'll lean into the silence while people type questions if there's any more. All right. Well, thank you, Maria. I appreciate you taking the time, and I know I didn't say the full introduction. My screen went blank right when I was about to start the presentation, but Maria has been a really wonderful asset to our industry, and we thank Perkins for their sponsorship of the symposium and our Cider Cup Awards this year, and for hanging with us as COVID has turned our whole world upside down, and for being such a good resource to the industry. I will send out her email address if you have individual questions for her that you don't want to ask in the chat box right now. And I think I'll stop recording now. Thank you so much, everyone.
Thank you.